Welcome to the third video in the Business Acumen Toolkit series, Business Intelligence. What tools does your organization currently use to monitor performance? How familiar are people with these tools? Are they widely distributed and discussed, or saved for boardroom conversations? Just a reminder that these videos were not created to be passively watched and listened to. This series is meant more as a discussion guide. The Business Acumen Toolkit series is brought to you by the Alaska Association on Developmental Disabilities with funding from the Alaska Mental Health Trust Authority. Your presenters are myself, Kim Champney,
and Brandon Cullum.
Brandon is the business brain of our team while I share my experience with strategic thinking and organizational development. You'll hear our different perspectives throughout the toolkit.
By the end of this video, you will be more familiar with core tools used for monitoring financial performance, and you will also increase your awareness of several key areas such as information provided by budget and utilization variances, the importance of a working cash balance, how to monitor debt, and tools for managing DSP time.
The most common business intelligence tools are the basic financial reports that provide information necessary to monitor an organization's financial performance. These reports include the income statement, which presents actual operating revenue and expense information, the balance sheet, which outlines what an organization owns and what it owes, and the statement of cash flow, which tracks actual cash receipts and expenditures. In addition, two other helpful reports for DD services providers are utilization reports monitoring over or underutilization of services compared to budget, and non-billable time, which tracks how much of a DSP's time is non-billable. It's important to identify your information needs and develop processes that meet those needs consistently and accurately. What are your organization's business intelligence tools?
The income statement looks a lot like a budget, but instead of outlining goals, it presents actual operating numbers. Income statement should include the budgeted numbers so that actuals can be easily compared to budget. The difference between budget goals and the actual performance shown in the income statement is called variance. This is an example of a very simple income statement. The top section provides information on revenue. The bottom section includes expenses. The net income at the bottom is the earnings left after all the bills are paid. This income statement provides the performance for the month as well as the performance year to date. This statement is based on a fiscal year of July 1 to June 30, so at the end of January, we are 7 months into the year. As you can see, January was a good month overall. We earned 7% more than we had planned, although we are still behind what we had hoped to earn year to date. Our goal is to be at 100% or over on revenue. Expense variance should run parallel with revenue or under, but not ahead of. The variance is the most informative number on an income statement.
A nonprofit balance sheet outlines what an organization owns and what it owes, articulated as assets and liabilities, respectively. This is a simple balance sheet. At the top are current assets, which are assets that are cash or could quickly become cash if needed. Accounts receivable are the payments you are waiting to receive for services already provided. Remember the income statement on the previous slide? Monthly revenue is what you've billed for, but you don't necessarily have the money in the bank yet. There's a gap. This is an important point addressed in the next slide on cash flow. Non-current assets have value but are not quickly converted to cash. An example is a building. You need to sell the building to convert to cash, but it certainly is a valuable asset. The key point of a balance sheet is to make sure your liabilities are not greater than your assets. This can sneak up on an organization, particularly if they have long-term debt, for example, a mortgage on a building. It's also important to track depreciation. How close are you to paying off your assets so you are financially prepared to replace them? This depreciation expense also runs through the income statement and should be accounted for in budgeting. If depreciation is not recovered through operations, then an organization may fall short of generating the cash it needs to replace assets. This situation would likely increase the organization's reliance on debt financing, further increasing the need for operations to generate extra cash to pay debt expense. By tracking assets and liabilities, an organization can maintain a global view of whether or not it is living beyond its means by making sure it does not become over-levered or too debt-heavy on its journey.
A statement of cash flows is used to track how an organization uses its cash resources. This more advanced management tool is not generally reviewed on a regular basis like the budget, income statement, and balance sheet. Mid-sized organizations may only see a statement of cash flows produced by their auditor. Smaller organizations may never see one, and large organizations may produce them monthly or quarterly for board and executive review. All the same, understanding this value-added tool can give organizations better visibility of the uses of cash that are not shown in the income statement. This is a very simple quarterly cash flow statement. Note the 3 lines at the bottom. How much cash is in the bank at the start of the period, what cash-related activity occurred during the period, and how much cash remains at the end of the period. Think of it like reconciling your checkbook. It is vital that cash needs are monitored and planned for. Because revenue is booked when the billable service is delivered, but cash payments may not show up for weeks after the revenue is booked, there is a gap between providing a billable service and having the cash to pay resulting expenses, which are regularly due before you can expect payment for services. To this end, organizations must maintain a working cash balance, which is the cash required to keep things running in the period between providing the service and getting paid. Cash is important. Employees want to be paid in cash, not promises of cash in the future. Planning for this balance requires some consistent accounting of upcoming cash expenses and how much cash you will need to make those payments.
Now we will move into DD-centric reporting concepts. The following reports are crucial tools for analyzing variance from revenue budgeting and DSP budgeting. Utilization is the primary tool used to compare how many Medicaid units were actually billed to how many Medicaid units were budgeted. Utilization is an important tool for identifying systemic issues, such as employees that aren't doing their notes or teams that are providing services that can't be billed for because they are beyond what's authorized. We will talk more about this in the gap analysis module. One important note is that leaders and managers need to remember services are being provided to people whose lives change. We need to respect the individual's choices, wishes, and particularly ability to be more independent than initially planned for. It's how quickly we respond and adjust to changing circumstances that is what we must work toward as a business. This is a standard utilization report by individual. The more detailed, the better. Consider using an Excel spreadsheet with a formula that configures utilization variance based on the individual service plan start date. Excel can flag individuals that are over or under a particular marker. For example, variances of greater than 10%. Utilization should be monitored on a monthly basis so trends can be responded to in a timely manner.
Non-billable time is another useful report to assess how closely we stick to budget. Here's the example of the DSP non-billable time budget from the resource planning module. This translates to approximately 10 hours per pay period of non-billable time per DSP. One way to monitor this is to develop a report that compares DSP paid time to hours billed during a set period, for example, a single pay period. The more detailed this report, the more quickly an issue will be addressed. If a manager is provided a report each pay period comparing individual employees' time paid to time billed as shown in this example, the manager will be alerted to discrepancies or concerns and can work through those with the direct support professional. There may be a reason employee 2 is so far outside of the 10-hour pay period average. The person may have used leave, which isn't reflected in this report, or perhaps the employee is providing services but not completing documentation in a timely manner. The organization will need to consider the financial impact of the situation and how best to address it. For larger programs, employee-specific reporting may seem overly time-consuming. This is an area where an effective use of technology can streamline this process. For example, a formula can be developed within Excel that flags employees who are above the 10 hours per pay period of non-billable time allowed. Supervisors will only be alerted to those workers and can address the issue which may be occurring. On the other hand, an organization can choose to monitor non-billable time more globally, look at a program's billed time compared to paid time, and dive deeper only if there is a concerning trend that needs to be addressed. An organization may want to track overtime in a similar manner. Overtime may be cost-effective to a certain point and should be budgeted as such. Allowing overtime to get out of control and exceed budget will result in unplanned cost overruns.
The focus of this module has been on describing reporting tools that are helpful for monitoring performance. We've reviewed 5 tools: an income statement, which reports the actual operating numbers and provides a comparison with the budgeted numbers; a balance sheet, which describes what an organization owns and what it owes; a cash flows report, the organization's checkbook; utilization, which reports on actual services being used compared to what was anticipated; and non-billable time, which tracks how DSPs are spending their time.
A goal without a plan is just a wish. Wise words to live by. A budget is comprised of goals, revenue and expense goals. By developing a set of tools that provides information on how the organization is doing on those goals, you are creating a culture of accountability as well as collecting information that will inform decision making. In addition, today's funders demand accountability. Many states have made the decision to move disability services into a managed care model. It is in your organization's best interest long term to understand very clearly the cost of providing services and to be able to demonstrate good stewardship and effective management when negotiating for sustainable funding. In the next module, we will address the now what question. Now that we have this information, what do we do with it?